What's up, you guys? Welcome back to the channel. Now, I know a lot of you guys are invested in NEO and you're probably planning on holding NEO for a long time into the future. And because of that, I want to show you guys a way that you can actually capitalize on NEO either trading flat, down, or even slightly up in the short term. And this strategy even works if you don't actually own shares of NEO and if you don't have enough capital to buy enough shares to do this strategy. But before we actually get into what this strategy is, for anybody who's new here, my name is Evan, and I make videos that show you guys different ways of making money in the stock market. So if that interests you guys, make sure you subscribe and hit the notification bell so you never miss when I upload. Also, before we jump into it, if you wouldn't mind going down and hitting the like button, I would really appreciate it, and it lets me know that you guys enjoy these video updates every day. Now, for what the actual strategy is, we're going to be using options. Now, I know a lot of you guys don't actually invest using options as part of your investing strategy, and I don't want you guys to exit out of the video quite yet. I want you guys to see really how easy this is and how anybody can do this as long as they own 100 shares of a specific company. So we're going over covered calls, and in order to do this strategy, you need 100 shares of a company. And so even though we're using NEO in this example, you can do this with any stock that you own 100 shares of. And if you guys don't own 100 shares, towards the end of the video, I'm going to show you exactly what you can do and a way that you can do this strategy using about half of the capital it would cost to buy 100 shares of the underlying stock. So just to give you guys an idea of where NEO is trading, they're down about 1% on the day, and they're trading right below $46. And the reason I'm putting out this video is because NEO has actually been trading pretty flat in the last week. And by using this strategy, the covered call strategy, you can actually capitalize on this sideways trading, and you can earn a premium using your 100 shares. So the first thing that you guys have to do is you have to go over to the options chain. And what we're looking for is we want to be selling a call against our 100 shares. Now, this is different from buying a call, where buying a call is much more risky and you need big fluctuations in the price to be right. When you're selling a call, you collect a premium and you keep that premium no matter what. And that's what makes this strategy so effective. There's actually people who are living off their premium collected by selling covered calls, and they live off that as their monthly income. Now, I think it goes without saying that you need a rather large portfolio to do that, but you'd be surprised at the premium that you can bring in, even with a smaller account and owning 100 shares of a company like NEO. But now, getting back on track, we want to sell a call that's above our cost basis or our average share price of our shares. So with using NEO, we're going to figure that our average share price is the price that NEO is currently trading at. Now, I know a lot of you guys have bought NEO in the past, and your average share cost is way below what NEO is trading for right now. And for those people, this may not be the best trading strategy to use, especially if you're planning on holding these shares for a super long time, and you would be devastated to let them go, because there is the possibility that your shares will get called away. And so you should do this with a stock that you're not married to and that you're okay letting go at a specific price. And you're going to set that price. So if we figure our average share price is right below $46, say at about $45.80 right now where NEO is trading at, we want to sell a call that's above that cost basis and choose a strike price that's above that. And in return, we're going to collect the premium, which you'll see on the right side here. As you get further and further away from the share price, the premium gets smaller and smaller. So if you bought NEO and your average share cost is $45.80, and maybe you're comfortable selling those shares at $48, well, you can sell a call on the $48 strike and you'll collect $33 in premium by July 16th, which is only in 3 days. And if the price stays below $48, you'll keep that entire $33 and you'll have $33 more in your investing portfolio than you did previously. Now, if the price of NEO does go above $48 at expiration, so on July 16th in this case, more than likely you're going to have to give up your shares at $48, but you still keep that $33 that you collected. Now, the downside to this, if NEO does go above $48 by July 16th, you'll end up losing out on potential gains of however high NEO goes above $48. So if NEO goes all the way to $50, you're losing out on potentially $2 per share, which would be $200. And that's the downside and the risk of selling covered calls, is that you may end up having to sell your shares even if the price continues going up. Now, like I mentioned earlier, you don't want to be doing this with a stock that you're afraid of letting go. If you're holding on to NIO right now and you plan on holding them for 5, 10, 15 years, which I know a lot of you guys probably are planning on holding NIO for that long, this could be a little bit riskier for you because then you possibly could be selling your shares at a specific strike price if NIO shoots up and goes above that strike price that you chose. But the benefit, even if NIO does go above that strike price, is you keep the difference between what your average cost is and what you sold as the strike price, plus the premium when you originally sold the call. So going back to our example of buying NIO at about $45.80, if NIO goes up to $48 and we get our shares called away, well, we collected $2.80 per share because NIO went from $45.80 up to $48, plus we keep the $33 that we collected as premium in the beginning. So you don't lose money as the price of the underlying stock goes up. You're just losing potential money that you could have made if the price surpasses the strike price that you sold at. I want to show you guys another example which may help you make sense of this. And so if we extend the expiration date out to July 23rd, which would be the expiration for next Friday instead of this coming Friday in 3 days, you can see that the premiums are a lot higher. And instead of just that $33, which we would be collecting by this Friday using the July 16th expiration, if we extend it out to July 23rd, at that same $48 strike, you'd be earning $95 in premium. And so if the share price stays below $48 by July 23rd, you collect that $95 and nothing happens. You keep your shares, and because you collected $95, you somewhat bring down your average share cost for all your 100 shares that you own. And so if you figure every week you collect about $100 on your shares, that would be about $400 per month, which is almost a 10% gain on the $4,580 that you paid to buy 100 shares at an average share cost of $45.80. And if you guys aren't exactly sure how you're making this money and how you make money from selling a covered call, if we take this same $48 strike price and we're selling a call at this strike price, there's things called the Greeks, and these are what makes up the premium, and this gives us an idea of how much it's worth. Now, one of the big factors that determines how much money you make is actually delta and theta. The delta, which in this case is 0.33, that's how much the premium is going to change based on a $1 price movement of the underlying stock. So if NIO drops by $1, the $95 in premium that we collected by selling this call, it's going to drop down to $62. Now, when you're selling a call and the premium goes down, that's good because you sold to open. And if you can buy it at a cheaper price than you originally sold it for, you keep that difference. So when you sell a call, you want the price of the premium to go down. And the other thing that affects how much money you make when you're selling a call is actually theta. Now in this case, the theta is negative 0.08. And this means that the premium is losing $8 every day that you hold it. And again, as the premium declines and we're losing money on the premium, that's actually more money in our pocket because we could buy it back at a cheaper price. So the theta is one of the big things that determines how much money we're going to make day after day until this call expires. So just by selling this call, which is essentially creating a new contract, and a contract is between a buyer and a seller, there's a buyer on the other end and you're selling the call. Every day that you're holding this covered call, you're making about $8 from the theta decay. Now earlier on in the video, I mentioned I was going to show you guys a way to do this if you have a smaller account and maybe you can't afford 100 shares of the underlying stock like NIO, because in this case you'd need $4,580 about to buy 100 shares. But the way you can do this without buying 100 shares is by buying a leaps option. If you guys don't know how a leaps option works, I actually made a pretty in-depth video and I'm going to link it up in the corner, and I suggest you guys go watch how that works. And then when you understand how leaps work, then you can get into the poor man's covered call, which I also made a video about, and I'll link that up in the corner as well. The poor man's covered call essentially takes advantage of the long-term leaps option, which is simulating owning 100 shares of the underlying stock, but at a much cheaper price than it would cost to actually buy 100 shares. When you buy a leaps, you can pay half the price of what 100 shares would cost, or possibly even less, and you still get those benefits of holding 100 shares, and you can sell covered calls against that long-term leaps. So again, if you guys haven't seen those videos, I suggest that you go watch those, and then you could come and rewatch this video and it might make a lot more sense as to how this works. Now, for those of you who made it this far into the video, I want to know down in the comments if you guys are actually taking taking advantage of this trading strategy and if you're actually selling covered calls against any stocks. And if you are, let me know what stocks you're actually selling covered calls on. Also, if you guys enjoyed the video, make sure you leave a like because it really does help out the channel. And with that said, thank you guys so much for watching, and I'll see you back here in the next one. Bye.